You want me to try pasting this link? You're saying that they'll be able to join in easily with this link. Not sure your name is coming as A. Ansar, is it? Okay. Okay, Ansar. I've just let me share that also link with them. Wait, I'm sharing it here also, and I'm putting the YouTube link. Give me 1 more minute, friends. Okay, I think I'm live on YouTube also now. I'll take this. So last episode, if you're not able to join in anywhere else, you can join in YouTube also. Okay, fine. Okay. I think we're good enough to start off. Okay, can we start off now? All right. Yes, friends, let's start off now. Everybody, please mute yourself. I've muted all of you. Right. So, friends, let's do the next question now. The next question is also something what we have done in our regular class. It's a question on not this RTP. This is the solution. Where did the question go? Okay, here is the question, and this is the solution, right? Now, this is something else. I'll move this off. Right. So we are here now, friends. So the next question is on mutual fund D and K, where they're asking you to work out the NAV after giving some information about the Sharpe's ratio and Trenner's ratio. Let's do this together now, friends. I'll draw a table now, particulars. Question number. What is the question number? We are talking about 10. Working note number 1. I'll put the basic data. Particulars. Okay. Now here you are having D mutual fund and then you are having K mutual fund. Okay. Then I'll write down NAV. Okay. So what is the NAV that you get over here? 70.71. And the other one you will get the answer as what? 62.5. In this, they have told that your equity portion is going to be 99%. So what is 70.71 into 99%? That is 70. And 62.5 into 96% is 60, friends. You can check it in your calculator. I know these numbers, that's why I'm putting it directly, but you can do it in the calculator also. So cash will be the balancing figure, 0.71, and here you'll get the number as 2.5. They have given you more information below. They have given you the Sharpe ratio, Trenner ratio, standard deviation, etc. From that, we can find out the beta. I'll again draw a table, particulars. You are having D mutual fund, then you are having K mutual fund. Okay, so they have given you the Sharpe's ratio. That turns out to be 2 and 3.3. Point number B, they have given you the Trenner's ratio. Trenner's ratio is 15 and 15. Okay. Now, from these two things, they're asking you to work out the standard deviation is also given 11.25 and 5. So, from this, I can actually work out the RP minus RF plus. That would be RP minus RF divided by standard deviation is Sharpe. So, I'll just do A into C. So, I will get 22.5 over here and 16.5 over here. Once I get this, therefore, I can work out the beta because it will be 22.5 divided by the Trenner's ratio of B. So that is 1.5 for the first one. Okay. And 16.5 divided by 15 will be 1.10 for the second one. So you get the beta for the first one and beta for the second one. Why we need this beta, I will explain to you in the next part. They have told there is no change in the portfolio and the average cost is 3 rupees per unit. Friends, if 3 rupees is the average annual cost, our data is given only for 1 month. Okay, it is given only for 1 month. So since it's given only for 1 month, what will happen is we have to divide it by 12. Okay, now say they have told consider 12 months in 1 year and they're asking you to calculate within a month. So they have told that market is going to fall by how much percentage? 5%. So I'll write down the next working note, revised equity quotient. There I will write down particulars, mutual fund D and mutual fund K. Mutual fund D and mutual fund K. So first I will write down the equity portion. So I think we got the equity portion as 70 for the first one and 60 for the second one, correct? Then I will write down percentage fall. The market is going to fall by 5%. My security has a beta of 1.5. So can I say my security is going to fall by 7.5%? Correct? And second one, it is going to fall by 5.50%. From this, can I go and find out what will be my revised equity portion? That will be 64.75 and 60 minus 5.5% will be 56.7. So this is my equity portion. Once I get this, I will write down the next working note. I will have to go and find out my revised cash portion. So again, I'll draw the same table, particulars, mutual fund D and mutual fund K. So here I'll write down what is going to be my opening cash balance. Opening cash was 0.71 and 2.5. Now I will convert my monthly expense. Friends, my yearly expense is 3 rupees. If I divide it by 12 months, it will be 0.25. Okay. So once you reduce this, my closing cash will turn out to be 0.46 for the first one, 2.25 for the second one. So friends, we got the equity portion. We have also got the cash portion. Now we will write down the revised NAV. Revised NAV. Particulars D and then you have K. So I will write down the revised equity portion first. How much is going to be my revised equity portion? 64.75 and 56.7. Then I will put up my revised cash portion. That is going to be 0.6 to 0.25. So when I add up these two things, I will get my revised NAV. That will be 64.29 and 54.45. All right. Yes. So we are done with this question.
So we need to add or we need to reduce that?
We need to add because it's equity part plus cash.
So it's 65.21 and 58.9.
Did I reduce by mistake? Oh,
Sir.
I added only, right? No. 65.21. Sorry, friends. I think I did that by mistake. I did subtract by mistake. It was supposed to be add. So how much will you get over here? It will be 56.7 plus
58.95.
58.95. Okay, perfect. So friends, we are done with this question also. It's a routine question that we have done in our regular class and in my crash classes. So it will be very, very easy.
Sir, excuse me, sir.
Yeah.
Please, sir. Working note number 1, sir, in this question.
Yeah. This is 99% and this one is 96%.
Thank you, sir. Thank you.
Fine. So I believe all of you are done with this. Okay, can I go to the next one now? All right. Let me go to the next part. So I think we are done with equity scheme. D and K is done. Now next question is on portfolio. Okay. An investor has decided to invest 1 lakh in the shares of 2 companies. All right. They have given you the projections and the outcome is given and the
Part 2.
and the probability is also given over here. Correct? Wait, I'll just mute all of you. Okay. Friends, hold on. I need to check if there's any chats in YouTube. I completely forgot about that. YouTube students, I hope you're all comfortable. Yes. And the probability is also given over here. Wait. Lavi Bansal, you want the theory marathon link? Can you please WhatsApp me or just have to go to the Class Plus app? I'll just share my number. You can just WhatsApp me here. I will connect you with the helpline who will give you access to the theory marathon. Okay?
Sir, for me also theory marathon I need, sir. Please, sir.
Yeah, Remy, I believe for you it's already there. It's already taken is what I understand. You can just do one thing. You can WhatsApp me. I will connect you with Blessy. She will arrange it for you. All right?
Please, sir. Thank you, sir.
Thank you.
Sir, there is a second part for the mutual fund question.
I'm sorry. Is there one more part left? Okay. Advise which mutual fund should an investor choose from a perspective of risk per unit of return. Okay. So friends, basically they're asking you to calculate which one is better when you compare the return divided by risk. Hold on. Have they given you the returns of the mutual fund in this question? There is one more add-on requirement over here, which is not there in the study material. Let's just take that part and discuss that. This part and all we have done. We got the answer here. Balance of cash also we got 65.21. Okay. Now RP minus RF is given. This is given and the beta is given. Hold on. Expected return is A plus B. 22.5 is RP minus RF. Okay, fine. Friends, this is a new requirement. Let's just do it in the way they have done it. We can actually work out the CAPM return here because they have given the detail, but RM is not given. Okay, let me do that also, particulars D and K. Friends, we have found out RP minus RF. Am I right? How much was the RP minus RF that we got? We got 22.5 for the first one. And for the second one, we got 16.50. So RP minus RF is normally nothing but RM minus RF into beta. That's how you get the return premium of the security. But now they have given you the risk premium of the portfolio is given. And they have given you the RF also. How much is the RF given in the question? Is it given as 7%? So from this, I can find out total return would be my risk premium plus my RF. So when you do this, you get the answer as 29.5% for the first one. And you get the answer as 23.5% for the second one. Then we know the standard deviation. How much is the standard deviation? 11.25 and 5. So now what will I do? I will do my return divided by my risk. Okay, it is the inverse of coefficient of variation, friends. 29.5 divided by 11.25 when you do, you get the answer as 2.62. And here you get the answer as 4.7. What is the logic of this? For every 1% of risk, I get 2.62% return for D and 4.7% return for K. So which one is better, friends?
Okay.
4.7 is going to be the better answer. Okay. So they have done risk per return. Fine. That way also, this is coefficient of variation. If you do it like this, okay, then you will have to find out coefficient of variation. There you will get lower the risk. This higher the risk, the better. You can do it the other way. Then you will get the number as 11.25 divided by 29.5. That is 0.38 here. Another one would be 5 divided by 23.5, that is 0.212. So when you look at this, lower the risk, the better. Again, you will get the same answer. Because here the logic is for every 1% return, how much risk are you actually taking? Okay. This is a new adjustment, friends, to the study material. I didn't read through it. Thank you for letting me know. Just go through this. If you have any doubts, do let me know.
Return by standard deviation mean?
Wait, Kirti, you're not audible. Can you please repeat once again?
Return by standard deviation, what it means?
Return by standard deviation, by what it means is that for every, okay, I'll give you the logic in writing. This means for every 1% risk, how much return I get. Whereas this one would be for every 1% return, how much risk I have. Okay?
Okay.
Perfect. So can I go to the next part now, friends? Okay? Fine, friends. So the next one is question number 11, which is a question on portfolio management. So they have given you the returns and they have given you the probability. Tell me, friends, the moment you see the return and the probability, what can you find out from this? I can find out the expected return and I can also find out the standard deviation. Am I right? Okay, let's do that for ABC first. So I'll write down question number 11. Working note number 1, return and risk of ABC. So friends, ABC we will call it as X, or let's call it as P. Okay. So the table format would be P probability, P minus P bar, P into P minus P bar the whole square. Oh God, P is also not a good alphabet to take here. I'll take ABC only and do it. Or I'll call it as A. A probability, A minus A bar, P into A minus A bar the whole square. 12, 14, 12, 14, minus 7, and what is the last one? 28. The probability is going to be 0.2, 0.25, 0.25, and 0.3. Do you get the answer as 12.55 over here? Now we need to find out A minus A bar. That will be minus 0.55, 1.45, minus 19.55, plus 15.45. 0.0605. 0.0605. 0.52, 565. 95.55. 71.61. You will get the total as 167.74. Of this, we should take a variance. That will be 12.95. Friends, exactly in the same manner, we are supposed to work out the return and risk of XYZ now. So I will write down working note number 2, return and risk of XYZ. Friends, I'm not going to do the entire workings here and waste our time. We can directly find the answer from the solution and discuss the remaining part. Because it will be a waste of time to just do the same thing what we already know. So I think we got the returns correctly. We got 12.55, 12.95. This one would be 12.10%. And the risk over here will be square root of 126. That will be 11.27%. Okay, this is for which company? XYZ. For ABC, let me put the summary here. We got 12.55 and the other one is 12.95. So XYZ and ABC summary. Okay. So once you write down this in your books, let's read the next part of the question. Comment on the risk and return. So friends, look at this. ABC has a higher return, but ABC also has a higher risk. Am I right? Okay. Compare the risk and return of these two shares with the portfolio of these in equal proportion. So friends, now they want you to find out the combined return and the combined risk. So I'll write down the next working note, combined return. Everyone tell me, how do you work out the combined return? Return of A into weight of A. So that is going to be 12.55 into 0.5 plus 12.10 into 0.5. So do you get the answer as 12.325%? Now, friends, we need to find out the combined risk. Tell me, which method are we going to use to find out the combined risk? Have they given the correlation coefficient? No, I think we'll have to work out the correlation coefficient, correct? So inside this, I will have to write down step number 1. We have to find out covariance of ABC with XYZ. So how do you do that? A, I'll call it as X, P, A minus A bar, X minus X bar, P into A minus A bar into X minus X bar. Okay. So I'll take the numbers again now. What are the numbers that you have? 12, 14, minus 7, 12, 14, minus 7, and the last one is 28. And we got the average of this one as how much? 12.55. For X, the numbers are going to be 16, 10, 28. And the other one is what? Minus 2. What is the average that you get over here? 12.10. Probabilities are going to be 0.2, 0.25, again 0.25 and 0.30. So A minus A bar, I believe we already have found out that earlier. Minus 0.55, 1.45, 19.55, and 15.45. Whereas X minus X bar, we'll have to work it out now. X minus X bar is, wait, I hope I have taken the right numbers. Correct, I have taken the right numbers. X minus X bar will be 16 minus 12.10, that is 3.9. 3.9, then you will take 10, that is minus 2.1 plus 15.9 minus 14.1, correct? Okay, so now I have to multiply this 3.9 into 0.55 into 0.2. So minus 0.429. 1.45 into 2.1 into 0.25. Minus 0.76125. 19.55 into 15.9 into 0.25. 77.71. 15.45 into 14.1 into 0.3 minus 65.35. Everything comes in negative. Friends, if I'm going arithmetically wrong somewhere, please help me out, okay? I think we'll get the number as minus 144.25. Therefore, your correlation of AX will be minus 144.25 divided by standard deviation X, standard deviation Y. That is 11.27, 12.95. You get the answer as minus 0.988, or approximately your correlation is actually minus 1. So once you get this, now in order to find out the combined risk, I will write down over here step number 2. That is combined risk. All right. So now when I say combined risk, what are we going to do over here? I will take standard deviation of X, weight of X. So that is going to be 12.95 into 0.5 the whole square plus, can somebody do the calculation and let me know what answer you will get? Plus 2 into 12.95 into 11.27 into 0.5 into 0.5 into minus 0.988. The whole square root. Can somebody please work out and tell me what answer you get over here? In the meanwhile, I'll just check the solution also. Covariance, we got the same, minus 144 into 2 into this into 0.5, 0.5, this, that. I think you get the combined risk as,
1.259.
do you get the answer as 1.25% over here? Okay.
Yes.
Fine, perfect. So you get the number as 1.25%. So friends, we have got the combined return over here, that is 12.325, and we have got the combined risk, that is 1.25%. Everybody clear so far? Perfect. So once we are done with this, let us go to the last requirement of this question. They are asking, advise the portfolio proportion of each of the above shares to formulate a minimum risk portfolio. So I'll write down the next working note heading. Minimum risk portfolio. Friends, for this I had given you the formula. If you want to find out weight of B, the formula would be A square minus AB divided by A square plus B square minus 2AB. Or in other words, if you're talking about the weight of ABC, I should take the variance of XYZ minus covariance of ABC and XYZ whole divided by variance of ABC plus variance of XYZ minus 2 into covariance of ABC and XYZ. So how much is the variance of XYZ that we have to find out now? Standard deviation of XYZ is 12.1. 146.41 minus 144 point something is your covariance. 144.25 whole divided by 146.41 plus variance of ABC, that is 12.55. 157.50 minus 2 into minus 144.25. Okay, so 290.66 divided by 592.41. All right, so what's the answer you get? Can somebody please work out and tell me? Do you get the answer as 49.06%? So 49% is the weight of ABC. Therefore, your weight of XYZ will be how much percentage? Approximately 51%. Shall we cross check? They've got 46, is it? So I think there is a rounding off difference.
Sir,
So
Yeah, tell me.
actually,
the variance is wrongly taken, I think.
yeah,
Which
variance
one?
of XYZ is 127.01.
How did I get 146? Any idea? Okay, tell me once
That's
again, what's the variance?
right.
127 point?
01.
Okay, and so here also it will be 127.01. So the total will change, right?
It's 167. The variance of ABC is 167.75 instead of 157.
All the numbers have got it wrong. Fantastic. 167.
75.
Okay, so can you tell me what is the total numerator and denominator that you got over here?
So just working on 1 minute.
$271.26, correct? $583.26.
Yes, sir.
46.5. What you said is right. Okay. So automatically here it will turn out to be how much, friends? 53.5%. 1 minute cool off time. Just go through this. If you have any doubts, let me know. Let's confirm, friends. That's yes, 46.5, 53 points. Perfect. All right, friends. Are you all done with this? Can I go to the next one now? Perfect. So we are done with question number 11 also. Let's go to question number 12 now. Okay. 12 is again a same type problem, friends, which we have done in the class. It is based on free cash flow to equity method. Okay, so let us do question number 12. So friends, major questions that has come in the RTP is actually covered in my material itself. Working note number 1, basic data. Mr. Amit is happy with the investment in a company. It's paying very good dividend. Last year, it paid a dividend of 2 rupees. So that 2 rupees is going to be your D0. Okay, now they have told the current share price is 150. So P0 is equal to 150 rupees per share. He is of the view that if he applies dividend discount model, the share is undervalued. As a financial expert, examine his view of dividend discount model that represents the fair value. So now they have given you the profit after tax and they have given you the equity capital. Equity capital is 1,300 crore. So I'll write down PAT is 290 crore. I can find out the number of shares from the equity share capital. That is 1,300 crore divided by 40. So do you get the answer as 32.50 crore? From this, I can find out the EPS. I get the answer as 8.92 rupees per share. Okay. I call it as E0 now. It is the earnings for year 0. That's because profit after tax means it's the actual profit of the company. Debt ratio is given. Long-term growth rate is given. Beta is given. RF is given. From that, I can work out my KE. KE will be equal to RF plus, how much is my RF? RF is 8.7 plus beta is 0.10 into RM minus RF, that is 10.3 minus 8.7. That is equal to 8.86% will be your KE. So we got the KE. Now we need to find out the free cash flow to equity. Wait, even before that, okay, they're asking you that dividend discount model, whether it represents a fair value, because we need to compare it with the free cash flow model. So I'll write down the next working note. Working note number 2, free cash flow to equity. So there I will take profit after tax. So profit after tax is how much? I think we got the EPS 8.92. Now they're asking add depreciation that is attributable to whom? Only equity holders. Here what they have given you is the total depreciation. So how much is the total depreciation they have given over here? 39. 39 into 27 is the debt ratio. So your equity ratio will be 73%. It will be 39 into 0.73. That is 28.47. Less CAPEX attributable to equity holders. So what will be your CAPEX
Sir,
attributable?
doubt.
Come again?
I have a doubt. They have mentioned it as depreciation per share, right? Then why are we doing this into debt percentage?
Okay, see what happens is depreciation per share means it is a total depreciation per share. Am I right? And that depreciation ideally is attributable to both equity holders also, debt holders also.
Okay, understood, sir.
So in this question, we need to take only that depreciation which is attributable to equity holders. Okay? Yes. Less additional working capital. So I think here it was 3.45. Again, we will multiply with 73%. You get 2.51. Okay. So once I do this, I will get the free cash flow to equity. So that is 28.47 minus, 8.92 plus 28.47 minus 34.31 minus 2.51. So do you get the answer over here as 0.57 rupees per share? This will be your free cash flow at the end of year 0. Okay. So from this, I will now find out my theoretical price. Price of an asset is nothing but present value of future cash flows. What is the growth rate that is told in the question? How much is the growth rate given? 1 minute.
8%.
8%, right? So this plus 8% divided by K that we found out 8.86% minus 8%. That is 0.6156 divided by 0.86%. Okay, then you'll get the answer as 71.58 rupees per share. So as per this, the price per share should be 71.85. But they have given you that it paid a dividend of 2 rupee and the share is currently trading at how much price? 150 rupees. He is of the view that if he applies dividend discount model, the share is undervalued. We'll check that later. First, let us check the arbitrage. Okay. What is the theoretical price we got over here? 71.58. What is the actual price that you got over here in the question? It is 150.
150.
So tell me, what is the status? Undervalued or overvalued?
Overvalued.
Overvalued. So are you supposed to buy or are you supposed to sell?
Sell.
You are supposed to sell. But they are saying using dividend discount model, they found out that the stock is undervalued is what they are trying to tell over here. Should we check that? We'll just check the price using Gordon's model. That will be P0 is equal to D1, that is 2 plus 8% divided by 8.86% minus 8%. You get the answer as 251 rupees per share. So friends, using Gordon's model, you get 251. Using free cash flow, you get only 71, which is a better method, friends. Free cash flow is better or Gordon's model is better? Free cash flow is a better method. Why? Because value of a business is nothing but present value of future cash flows. If the company pays the entire money by way of dividend, only then Gordon's model becomes a popular model. Okay, that's why they said that here it's 251, actual price is 150, so they took it as undervalued. But in reality, it is supposed to be what? Overvalued. So we are done with this question also, friends. I'll give you a minute. Read and understand or scribble it down. Then we will go to the next question.
Sir, excuse me, sir.
Yes, tell me.
Sir, the last point, please repeat, sir. How a free cash flow model is better? When Gordon's model is better?
See, always free cash flow method is better. Always. Okay. Gordon's model will be useful only if entire profits are distributed by way of dividends.
Mm-hmm.
Then your free cash flow and Gordon's model will always give you the same number over there, correct?
Mm.
Yes.
Thank you,
Gayatri, you
sir.
want the first page?
Thank you so much, sir.
Thank you. Done? Fantastic, friends. So we are done with this question also. Now, friends, we'll go to the next question, which I think is the last question. And friends, this question is different from what we have done in our class. But you want a minute, Gayatri? Sure, sure, sure. Please take your time. Please take your time. It is similar to one question that we have done in our international financial management chapter, where we had African rand, etc. But inflation is not given overall. Inflation is given separately. So we'll work out this question slow and steady, and we'll finish off with this problem also. Next page, Gayatri. 1 minute. Sure, Gayatri, no worries. You take your time, write it down. Yes. Can I go to the next page now? Yeah. All right. So I think all of you are done with this. Shall I go to the next question now? Okay. Question number 13. Mr. Vishwas, a friend of Mr. Pramod, who is one of the directors of Ashirwad Limited, is a citizen of Mauritius. I think we'll have to understand these people now. We have one fellow called as Vishwas. Wait, what is the question number?
Sir, what is the chapter name, sir?
Question number 13. Everyone, please mute yourself.
So chapter.
Okay. Okay. Pratik, are you speaking to me? I just muted you thinking you're speaking to somebody else there.
No, sir. Chapter name, sir, in our chapter name, sir.
Chapter name he's asking, International Financial.
Chapter name is International Financial Management.
Okay. Sorry.
All right. Yeah. Okay. Mr. Vishwas, a friend of Mr. Pramod. So now the second fellow over here is Mr. Pramod. All right. So Mr. Pramod is one of the directors of Ashirwad Limited. So this fellow is a director of Ashirwad Limited. Okay. So as a director of Ashirwad Limited, is a citizen of Mauritius. So he is a Mauritius citizen. All right. His immediate family members, including his parents, are born in India, residing in India. He has many friends in different parts of India, due to which he happens to visit India on a frequent basis. He, along with Mr. Pramod, evinces interest in setting up a business in India. So this fellow wants to set up a business in India, but he's in Mauritius. So he'll invest from Mauritius, but then the returns he will start getting in India. Accordingly, a company called Aerocious Private Limited got incorporated in Mumbai. Aerocious Private Limited. Wonderful. Pramod from Mauritius is starting Aerocious in India. To start, he received business proposal from one of his friends, Nimish, a consultant. It is estimated that in equivalent terms, the business shall require an initial investment of how much? 100 million Mauritius. MUR means I'm not sure what is the name of that currency here. MUR currency full form. It's Mauritian rupee. So even there the term rupee is used. Okay, so MUR is 1 Mauritian rupee, 100 million, and thereafter 2 million in each year will be required as by way of capital funding. Okay, right. So I'll just write down working note number 1, basic data. Point number A, initial investment, that is 100 million Mauritian rupee. Okay. Yearly working capital requirement will be 2 million MUR. 2 million MUR. Okay. He wished to evaluate whether the business proposal is viable or not viable. The information related to the exchange rate and inflation rate is given below. So the spot rate is 1.88 rupee per Mauritian rupee or Mauritian dollar. They're using two words. MUR is Mauritian rupee. They're calling it as Mauritian dollar. God knows which is correct. So I'll just write down over here spot rate 1.80. Sorry, 1.88. 80 is the actual rate right now. Rupee bar MUR. Okay. Down they have told inflation in India is 6%. Inflation in Mauritius is how much? 5%. So tell me, friends, which one will be RH and which one will be RF? Mauritius will be RF because it is the denominator. Rupee will be RH because it is a numerator. Everybody clear? In the question that we did in class, it was Rand per rupee. So African Rand became RH and rupee became RF. Inflation will remain the same for the next 4 years. So here we are having a life of how many years? 4 years. So this part all we have done in our class. INR 8 crore out of the initial investment shall be required for setting up a plant. So investment in plant is going to be how much? 8 crore. 8 crore, that is in INR, correct? I'll put INR. All right. Okay, then what have they told? The useful life of the plant is 4 years. At the end of the 4th year, the salvage value of the plant shall be 80 lakhs. So I'll just put it below this. Life of the plant is 4 years. And you will have the salvage value at the end of this is going to be 80 lakh rupees, correct? Correct. Depreciation is on straight line method. So friends, here itself, can I go and find out how much will be my depreciation? That will be 800 lakhs minus salvage value is 80 divided by 4. Do you get the answer as 180 lakhs? 180 lakhs. All right. Next part. 40% of the investment shall be through debt funds from Mauritius at a cost of 10%, while the remaining fund shall be arranged by him and his friends. So 40% of funding is through debt funds. Okay. Next part. Okay. At the rate of 10% post-tax. That's what they have told over here, right? ROE or the expected returns over there is how much percentage? 12%. Now they have given you the revenue and cost in real terms. So friends, we have to convert this revenue and cost into money terms. Assume that the applicable tax rate in India is how much? 30%. Tax rate in India is 30%. Since there is double tax avoidance agreement, The companies will not required to pay tax in Mauritius once it has paid tax in India. Now they have given the inflation of revenue, inflation of cost is given separately. He wants to find out whether the project is feasible or no. Friends, I'll go a little slow here. Just read through this, understand, scribble down till here. Then we will find out the hidden information one by one. All right. So friends, here you have all these cash flows. From this cash flow, part number 1, can we start by finding the future exchange rate, friends?
Sir, 1 minute, sir. I'll write down the last points.
Yeah, please.
Thank you, sir.
All right. Okay. So now first what I will do, I will go and find out the future exchange rate. So here I'll write down here computation, and the third column heading would be exchange rate. Okay. Year 0, we already have an exchange rate, correct? What is the year 0 exchange rate given in the question?
0.88.
1.88, correct? Rupee bar MUR, correct? So year 1, it will be 1.88 into, sorry, it's not like this, 1 plus RH. RH is what? 6%. So it will be 1 plus 6% divided by 1 plus 5% is equal to F divided by spot. Do I get the answer as 1.8979? Okay. Year 2, I can actually use the same ratio, 1.06 divided by 1.05 into 1.8979. Same equation, you will get 1.9159. Year 3, you will get 1.9344 and 1.9526. Yes. Perfect. Now, friends, once we are done with this part, I'll go to the next one. So we'll read the basic data again and see what else we can find out. We have the initial investment is given and the working capital is also given. So can we convert these also into rupees right now? Because we'll have to convert this at a future exchange rate. Gayatri, you're still writing? Yeah. All right, friends. Can I go to the next part now, Gayatri? Okay. So now what I'll do is I will just convert the investments into rupee. I'll write year computation INR. Friends, in this question, INR, they're doing it in crore. So year 0, how much is my investment that is coming over here? 100 million MUR into 1.88. But this I'll have to divide it by 10. Why divide by 10? 10 million is 1 crore. So 100 into 1.88 divided by 10 if I do, I will get 18.80 crore for the first one. Year 1, they need to invest 2 million again. Now this time the exchange rate is 1.8979. Correct? And then I will divide it by 10. Do you get the answer as 0.3796 crore? Year 2 again you will have the same 2 million, but now you have a different exchange rate, 1.9159. Point 3832 crore. Like this, friends, year 3, it will be this into 1.9342. But I will divide it by 10. 0.3868. 3868 crore. And then in year 4, it will be 2 million into 2 million into what is the rate for the next fund? 1.9526. 0.390. 52 crore. Why 10 is just to convert into crores. Million, 10 million is 1 crore. Indian rupee they have given in crore. That is the only reason, no other reason. Okay. Can you please put this in your books?
Sir, your
Yeah.
MUR is a stronger currency here.
MBR is a stronger currency, correct. So 2 million will be actually 3.79 million rupees. But in crore, it's showing 0.37 crore. That's all. Okay. MBR is a more stronger currency. Right. I think that's what we saw in Google also. It is 1.8 Indian rupee for 1 Mauritian rupee. Okay. Right. Fine, friends. So I believe we are done with the converting of investments into rupees. Now I'll go to the next part. Let's read the basic data again and see what's available there. Initial investment we covered. Okay. This is done. Spot rate also we could find out the forward rate. Life is given. So we got the depreciation value also we have got over here. Now they are saying 40% funding is through debt and 10 at the rate of 10% post-tax. So friends, KE is also given, KD is given, weight of debt is given, weight of equity is also given. From this, can I find out my WACC? I can find out that here itself. I'm not going to our next page. WACC will be equal to 10 into 0.4 plus 12 into 0.6. So can you tell me what answer will you get over here? 7.2 and 4. Will you get the answer as 11.20%? Can you just write down this in your books now? All right, friends. I believe all of you are done with this part. Can I go to the next one now? Okay. Right. Fine. So once you're done with this, okay, I'll go to the next one. So we are done with future exchange rate. We are done with the conversion part also. Now, friends, I think the next part left to be done is we have the revenue in real terms and we have the inflation given. Cost in real terms, so we need to convert these two things into money. So I'll write down the next working note heading. Money cash flow of revenues in India. I'll draw a table here. Computation result. Okay. So here if you see year 1, what was the revenue that they have given over here? 6 crore. But the inflation is going to be 10%. So do I get the answer as 6.60 crore? Year 2, revenue is 7 crore. Inflation for the first year is 10%. Second year is 9%. So when you do like this, you'll get the answer as 8.393 crore. Third year, your revenue is going to be 8 crore. First year, 10%. second year 9%, and the third year your inflation is going to be 8%. So when you multiply, you'll get the answer as 10.3594 crore. Year 4, your revenue is again 8. It will be 8 into 1.1 into 1.09 into 1.08 into 1.07. Okay. So what is the answer you get over here when you do like this? 11.0845 crore. All right. So these are the money cash flows of revenue. In the same way, I have to go and work out the money cash flows for variable cost also. So I'll write down the next working note. Money cash flow of variable cost. Variable cost or total cost? It's the total cost, not variable cost. Money cash flow of cost. Here. Okay, Gayatri, you want me to slow down? Please write down, Gayatri. This session will be a little fast, Gayatri, because I want to cover maximum questions and I'll be sharing these notes with you. So you just have to scribble down all the answers wherever possible, and the final handout will also be given to you. Otherwise, what will happen is too much of time will go in just writing the notes. That's the only objective. Please write down, Gayatri. Take your time, write it down. Okay. Because regular class, I can give a lot of time because we have 150, 200 hours. Now exams are only 1 month ahead, right? That's why. YouTube students, I believe you're all comfortable there. No need to say sorry, Gayatri. I'm just sharing the perspective and objective with which we're taking class right now. Okay, nothing else. I believe all of you are done. Okay, now. So here what will happen, I will write down year. Then we will have computation and we will have the cash flow. So friends, year 1, what is the variable cost that you have over here? Cost that you have over here, 3. It will be 3 into 1.12. That will be 3.36 crore. Year 2, the variable cost is how much? 4. So 4 into 12% for the first year, 10% for the second year. So you'll get the answer as 4.928 crore. Okay. Year 3, it is again 4 and 4. So it will be 4 into 1.12 into 1.10 into 1.09. So that will give you the answer as 5.3715 crore. Year 4, it will be 4 into 1.12, 1.10, 1.09 and 1.08. So that will give you 5.8012 crore. These are going to be your money cash flows in cost for the following calculations. Okay. So friends, we got the revenue. We have also got the cost. So now what we are supposed to do is, we are supposed to take the revenue, reduce the cost. When I reduce the cost from the revenue, what will I get? I'll get the profit, but I have to reduce depreciation also. Then I'll get PBT, tax, PAT. I will have to add back depreciation to get the cash flows after tax. So I'll write down the next working note now. Cash flow after tax. So I'll write here, you have 1, 2, 3, 4. Okay. So first I'll start with revenue. So I believe our revenue is 6.6, 8.393, 10.3594, 11.0854. And your cost turns out to be 3.36, 4.928, 5.3715, 5.8012. Okay. From this, I will reduce my depreciation. That is, we got 1.8 as our depreciation, friends. You have to give a heading in crore. Okay. So then I will get my profit before tax. That is 1.44, 1.665, 3.1879, 3.4833. From this, we'll reduce the tax. Come again, Pratik.
Salvage value.
We'll take that separately. We are only considering the other things. Working capital also we have not considered here.
Okay, okay.
Okay, so we are just taking the in-between profit-based cash flows over here. So your tax is going to be 30%, 0.432, 0.4995, 0.9564 will come, 1.0450 will come. So from this, you can find out the PAT. The PAT over here will turn out to be 1.008, 1.1655, 2.2315, 2.4383. Once you get this, what will you do? You will add back depreciation. So once you add it back, you will get the cash flow after tax. 2.808, 2.9655, 4.0315, and 4.2383. Okay, so once you get these cash flows after tax, now we have to go and calculate the NPV. For calculating the NPV, ideally to this, what am I supposed to do? I am supposed to also consider the working capital that has been incorporated, correct? So how much was the working capital that we found out over here? 0.3796, hold on. 0.3796, 0.3832, correct? 0.3868, and the last year will be 0.3905. Apart from this, you also have a scrap value now. How much was the scrap value that was told? I think 80 lakhs, correct? So that is 0.80 crore. That will be an inflow. Okay. And apart from this, what will happen, friends? At the end of the period, whatever working capital you have invested, you will be able to recover the working capital. So it's called as working capital recovered. Okay. So how do you do the working capital recovered now? Add up all these numbers. No, I don't think we should add up like this. 1.54. There are two opinions, friends. Your textbooks have just added all the four working capital. But in reality, what I feel is that 2 million is invested. No, correct, correct. It's correct. 1.5401. So how did I get this? Sum total of all these things. This is in total 1.5401. If I add up this plus this is equal to 1.5401. Fine. So once you get this, then I will take 2.808 minus 284. 2.9655 minus 0.3832 will be 2.5823. 3.6447. And what about the last one? 2383 minus 0.3905 plus 0.8 plus you get 1.5401 completely. So you'll get 6.1879 as the fourth year cash flow. Okay. So these are the crores that you get over here. And can you please understand till here first? So we have got the cash flows in Indian rupee. Beautiful working note. Yeah, Harshini, we just added these four numbers. See, working capital, every year they're investing money, right? Let's go down now. See this plus this plus this plus this. If you add up, you will get 1.5401.
Excuse me, sir.
Yeah, tell me.
is it like mandatory that we should always add up the working capital that we use?
Yes, because ideally these are all additional working capital, right? So this total working capital blockage will go on increasing, correct? Suppose you had 10 earlier, then it became 12, then it became 14, then it became 16, then it became 18. At the end, you will recover the entire 18. So, but every year you will only show 2, 2, 2, and 2 because extra how much is coming over there? Only 2 is coming over there. Am I right?
Yes, sir.
So that's what the total working capital will be recovered over here. All right, fine. So friends, once you get this, let us now go and read the question again. Show up the INR calculation in crore. This demonstrate whether the investment is viable or not viable. Have they asked which approach to use, home currency or foreign currency? Nothing is told, right? So we can either solve it using home currency approach or we can find out using foreign currency approach. So I'll write down the next working note. NPV using home currency approach. So how do you do it in home currency approach? You will take all the cash flows in rupee and the discount factor also will be of India. Here, have they given the discounting factor?
Rate of return is 12%.
No, we found out the
12%.
WACC, right?
Yeah.
Is that in India or in Mauritius? At 10 for remaining funds are arranged by the expected. It is in Mauritius, friends. It's in Mauritius. So we have found out the WACC in Mauritius. So we need to have our cash flows also in Mauritian rupees only using foreign currency approach. Okay, I will write down since VAT is in Mauritius, NPV has to be using foreign currency approach. So friends, what we have to do here is we have to take the cash flows in rupee. Then we should take the exchange rate. From this, we should be taking the cash flows in dollar. Are you getting my point? Then I will take the discount factor, discounted cash flow. So year 0, we are investing 100 million in Mauritian rupee, not in dollar, in MUR. MUR. So here we know it's already 100 million. So I'm not changing that. Year 1, what is the cash flow that we finally got? 2.4284. 4284. This is in crore. This we have to give in millions. Year 2, you got as 2.5823. Year 3, you found out as 3.6447. Year 4, you got it as 6.1879. Okay, and what was the exchange rate that we found out earlier? I think it was 1.8979. Rupee bar MUR. So now this is in rupee. So I'll have to divide. Okay. Second one was 1.9160, 1.9342, and 1.9526. 2.4284 divided by 1.8979 will be 1.2795 into 10. So convert into million. So 12.80. 12.80. 2.5823 divided by 1.9160 into 10. 13.47. 3.6447 divided by 1.9342 into 10 will be 18.84. Divided by 1.9526 into 10, that is 31.69. Now, how much is the WACC that we found out over there? 11.2%, correct? You have to put 11.2% over here and you should find out the NPV. Let me just confirm the numbers, friends. Give me a minute. Yes, 11.50 is what they have got. Yeah, that's 12.79, 13.47, 18.84. Perfect. The numbers are correct, friends. When you do this, you get the NPV as minus 43.16 MUR. So everyone tell me NPV is positive or negative, friends? NPV is negative. Hence, will you accept the project or reject the project?
Reject the project.
Reject the project. Friends, I'll give you 1 minute full of time. Please go through this. Beautiful question, friends. This is the only one question which is slightly different from what I have done in my material. So please note it down.
Sir, how many marks this question is for?
In the RTP, they have not given any marks. For exam, this should come for 12 marks or 8 marks, 8 or 12.
Excuse me,
Fine. Yeah, tell me.
sir. I have a doubt in that working capital recovery part.
Okay,
Sir, in each year we are considering the additional working capital.
correct.
Can you please explain the logic of how it is an inflow in the last year?
How it is the?
How it is an inflow in the last year?
Okay,
The
I'll
working
explain to you with the
capital-
help of another example. Okay, suppose you are running a gold showroom. Okay, year 1 you are having showroom number 1. Year 2 you are having showroom number 2. Year 3 you are having showroom number 3. Okay, showroom 1 you are having 100 lakhs of gold already. The moment you opened showroom 2, you brought in extra 50 lakhs of gold. So now tell me, what is your closing balance over here?
150.
150 lakhs. Year 3, you bring extra 70 lakhs of gold. Now tell me, what is your closing balance at end of year 2? Year 3?
220.
220 lakhs, right? Now, this 100 lakhs is a cash flow. This 50 lakh is also a cash flow. This 70 lakh is also a cash flow. At the end of the third year, if you shut down your business, you will release how much value of gold? 220 lakhs. Am I right? How did I get this 220 lakhs? 100 plus 50 plus 70. Are you clear
sir,
now?
got it. Yes, sir. Thank you.
Thank you so much. So friends, we are done with this part and we are done with this question also. Now, friends, there are two new theories that they have brought in over here. I saw the same theory in MTP also, succession planning. This was not there in the earlier syllabus. So friends, succession planning is a good way for companies to ensure that the business are fully prepared to promote and advance all employees, not just those who are at the managerial level. Explain. Friends, I'll just give you a hint of this. What is the meaning of succession planning is? Suppose a company is running with a CEO.
Sir, Padma Priya is asking for the previous page.
You want the previous page, Padma Priya? 1 minute. 1 minute. Yes, Padma Priya. Please go through this. Jacob, you have a doubt. Concept of talent pipeline and environmental, social, and governance financing. Jacob, which chapter did you see this question from? Done? All right, Padma Priya. Thank you so much. So friends, this question on succession planning over here in a very simple terms, what it means is that suppose a company is having a CEO. Tomorrow, the CEO has a problem with the company and he leaves the company. Immediately, we should have CEO2 that is ready and in line. This planning that if A leaves, B will take over his position is what we call it as succession planning. Are you clear with this part? Okay. So I'll just show you the theory part of this one. We'll just read and discuss it. Okay. So it goes like this. Where did my solution go off? Okay. Okay, so here they are saying, okay, succession planning is a process of identifying critical positions within the organization and developing action plans for individuals to assume these positions. This identifies the future need of the people with skills. So basically, if CEO 1 is leaving, you should have CEO 2 who will be in track. Okay. So now they are told need for succession planning can be explained as below. So down, they have told risk mitigation. First, if CEO 1 leaves, suddenly the company will face a lot of pressure. In order to overcome that, if CEO 2 is already ready, the moment CEO 1 leaves, 6 to 9 months of time it will take, you will actually have a very smooth transition. Second point they're saying is cost removal. Okay. If existing leader is culpable of gross negligence, fraud, etc., when the new fellow comes in, automatically what will happen? Such fraud, etc., will be automatically identified. And at the same time, the new fellow should not be responsible for any of the fraud that has been taken care of by the earlier CEO. He should be only liable for what actions he takes on his own. Okay. Then there is a third point. Is this what you were telling? Talent pipeline. Okay. Talent pipeline. Succession planning keeps employees motivated and determined as it helps them to obtain more visibility around the career path, retaining knowledge bank by creating over a period of time and leverage upon the same. Friends, basically what is the need is that talent pipeline means they are going to keep a list of people ready. If A leaves, B will be there. Beyond B, you will have C, D, and E. They are all talented people. So if B leaves, automatically C will take over the position or D will take over the position. That is what you call it as talent pipeline. Conflict resolution mechanism. Okay. If you do planning in advance, in the end, when the CEO is leaving, at that point of time, you will not face much of a problem over there, is what they are trying to tell you. Okay. Last one is aligning. In family-owned businesses, succession planning helps to align with the culture, vision, direction, and values of the business. Friends, many businesses over here are run by family-driven people. So if it is run by family, suddenly an outsider is coming in. This outsider will take some time to adjust to the family cultures. Only then he can enroll inside. So that alignment time also will be available if you have succession planning coming into the picture. So these are the reasons for what they do the succession planning, like risk mitigation, risk will be reduced. Cost removal, fraud of earlier fellow should not go to the second fellow. Point number 3 is talent pipeline. You will have a pipeline of people ready with talent in your company. Any conflicts come, resolve it early rather than doing it in the end, and you align with the company's cultures and values. Everybody clear with this part? The last question they're asking is, in the current scenario of globalization and growth, responsibilities of CFO has drastically expanded. So CFO's role has expanded. This is there in a basic chapter. First role is what? Risk management. He should ensure that company does not face much risk. Whatever risk is there, it should be managed. Either use hedging technique or use multiple ways, but manage your risk. Supply chain. Friends, normally supply chain is not something that the CFO handles directly, but in the new generation, even though there are people handling the supply chain, CFO should also ensure that they understand the supply chain, because money will go in the supply chain. What is the supply chain? Raw material you buy, convert into work in progress. Work in progress, you give it to the wholesaler. Wholesaler will give it to the retailer. Retailer will give it to the customer. This entire chain, you're transferring, and money is also involved. So as a CFO, you should understand the supply chain so that you can manage the money of this company. Mergers, acquisition is also something what CFOs are doing these days. Last point, environmental, social, and governance financing. With the evolving concept of ESG, the role has shifted traditional financing to sustainability financing. Okay, let me explain this to you. Environmental financing, social financing, governance financing. Every company needs to be environmentally compliant. Okay, this is there in SEMPE also, friends. There is a case study with the name of Shandar Bangles. I don't know if you have gone through it. Bangle industry, they face a lot of pollution. Environmental pollution, sound pollution will be there, air pollution will be there. So in order to maintain this, every bangle driven company ethically is supposed to give their employees some rest time. They should have nature around them so that they can relax and rejuvenate themselves. There should not be injuries happening over there. Everybody should be given mask, gloves, etc. So funding required to keep your company environmentally, socially sustainable is what they call it as environmental, social, and governance financing. Jacob, are you clear with these points now? With this, we are done with the RTP May 24, friends. Shall we just take a 5 minutes of cool off time, friends?
Yes, sir.
Yes, sir.
After the 5 minutes, we will start off with MTP session series number 1. Okay?
Sir,
Friends,
don't
we'll go
disconnect.
on. Yeah, tell me.
Don't disconnect, sir.
I'm not disconnecting. Okay, I'm sticking on 5 minutes, just a cool off time for all of you. Okay? All right. Thank you.
Thank you, sir.
Thank you, sir.
Thank you.
getting error.
Friends, I'm back. Shall we go to the next part now?
Yes, sir.
Okay, sir.
So we are done with RTP. Now let us start with MTP Series 1. Yes. Okay. Yes. So friends, even when you go by MTP Series 1, whereas MTP Series 2 also, friends, most of the questions, I think 90% of the questions are already done in our class. So that's actually a good news. And even the MCQs have come from directly from the questions that we have done. So that would actually, it's a positive news because that would mean that we have covered major portion. And hopefully, if MTP1, MTP2, RTP are all in the same trend, exam also should be in the same trend itself. Okay. Only one thing that I see is that they are trying to dig out theory from different places. Okay. Like which is normally a theory that you will just read and forget. They have dig that out and they are trying to put it as an MCQ question. That one area we need to focus a little extra now. All right. Yes. Now. So here you have mutual fund X, Y, and you have Z. Okay. So I'll just write down. I will write down MTP Series 1. Take a fresh page now. So we are doing question number case scenario 1. They are having two case studies over here. Case scenario number 1. We have to anyway start with basic data because until we analyze this question, friends, is the exact question we have done in our class also, friends. Mutual fund X, mutual fund Y, and mutual fund Z. Okay. So here you will have amount of investment. So that is turning out to be 4 lakhs. Then you have 8 lakhs. And the third one is going to be again 4 lakhs. All right. NAV at the time of purchase. NAV 0 is how much over here? 10.3. Then you have 10.1. and then you have 10. Okay. Dividend they have given as, okay, at the time of purchase. So from this, can I find out the number of units A divided by B? That is 38,835. Hold on. At the time of purchase. Am I right? Yes. 38,834.95 is what you get over here. 834.95. Second one is going to be 8 lakh divided by, or hold on, amount of investment and the NAV at the time of purchase. So 8 lakh divided by 10.1, 79,207.92, 7.92, and the last one will be 40,000 units. Okay. Now over here, they have given you the total dividend. From this, I can find out the dividend per unit. So 9,000 divided by 38,834.95. When you do, you'll get the dividend as 0.23. Second one, the dividend amount is 0, so I don't have to worry. Third one is 6,000 divided by 40,000. You'll get the answer as 0.15 rupees, correct? Now they have also given NAV1. How much is the NAV1 they have given? That is 10.35. Then you have 10, and the last one is 10.30. Okay. From this, they have told the yield per annum is given. Effective yield per annum. Yield per annum will be 9.66% minus 11.66%, 24.15%. Okay. Are you all clear with this part? X, Y, and the last one is Z. Okay. So from this, we need to go and find out what is the period for each one of these. So I'll write down working note number 2, duration. Yeah,
Sir?
tell me. Yeah.
Is our mock test question paper?
No, MTP.
Okay.
ICI MTP is what we are doing here. Okay.
Same question we also had, sir, in mock test.
I don't remember which one we had in our mock test. Now I'm doing too many questions every day. So I'm
Same
forgetting it.
question.
Yes, sir. We had something similar.
Okay. And we had in our material also, in our workbook, if you remember, we have done this question. I've
Yes,
done
sir.
it in the regular, I've done in the crash also this question. Okay.
Okay,
Right.
okay.
So friends, for the duration purpose, how will we find out the duration? I'll do it for the first one, that is mutual fund X. Formula will be NAV1, that is 10.35, minus NAV0, that is 10.3, plus D1. How much is the D1 that you got over here? 0.23, divided by NAV0 into 365 divided by whatever is the actual number of days. This will give you the answer as 9.66%. Okay. So you have to do a reverse working to find out how much is the value of X. So 10.35 minus 10.3 is 0.05 plus 0.23 divided by 10.3 in percentage will be 2.718% into 365 by X is equal to 9.66. So 9.66 divided by 2.718 will give you 3.55. Okay, that will be 365 divided by this. You will get the answer as 103 days. Therefore, it will be 103 days for the first one. Okay, for the first one. Same way we need to do it for Y and we need to do it for Z. So I'll write down the next working note. Duration of Y. So for Y again, I have to use the same equation. 10 minus 10.1, 10 minus 10.10, NAV1 minus NAV0 plus divided by 10.1 into 365 divided by X should be equal to, what is the yield told over here? Minus 11.66%.
Sir, here dividend we should not add us.
Wait, is there dividend coming in this case?
Oh, zero,
Base
zero.
to
No,
dividend
sir.
is 0, right?
It is 0, 0. Okay.
That's right. Okay. So you get this into 365 by X is equal to 11.66 percentage. That will be 11.77 percentage. So take the X up and put this down. So it will be 365 divided by this. I think you'll get the answer as 31 days. Please cross check if I'm doing any arithmetic error over here. Okay. Same way I'll put working note number 4 also over here. That is the duration of Z. So what will be the calculation for duration of Z? 10.30 minus 10 plus D1. How much is the D1 that we found out over here? I think 0.15, correct? Divided by 10 into 365 divided by X is equal to 24.15 percentage. So 0.3 plus 0.15 divided by 10 will be 4.5%. 4.5%. So 24.15 divided by 4.5. 68 days. That will be the answer for the third one. Perfect. So friends, we got the duration of X, we got the duration of Y, and we have also got the duration of Z. Okay. Now I'll go to the next part. I think once we get the duration, okay, from this now we'll start reading the requirements. The total NAV of mutual fund Y is what they're asking first. So I'll write down total NAV of mutual fund Y. What is the closing NAV we found out for mutual fund Y, friends? 10, correct? And how many units we got over here? Into what is the number of units for Y? 79,207.92. 7,92,097 rupees will be the total NAV. Shall we just cross check this now here? See, so the answer is going to be C for the first one. Okay, 792,079. We've got exactly the same answer. Let's read the second requirement now. Total yield of mutual fund X in terms of rupees would be approximately how much? So, yield of mutual fund X in rupees. So, friends, how do you find out the yield in rupees? That will be NAV1 minus NAV0 in total figure plus dividend in total figure, correct? So how much is the NAV1 that this fellow has? 10.35 minus 10. So I'll write down unrealized yield. Then you have realized yield. That will be 10.35 minus 10.3 into how many units you found out over here? 38,834.95. You get 1942 approximately, and then you will have realized yield. In our case, the realized yield is only the dividend amount. So how much is the dividend amount? They have got 9,000. If you add up these two, you'll get 10,942. Am I right? 10,942. Yes, they have got 10,941.73. So the answer is going to be option number A. Number of days for which mutual fund X would be held approximately. I think we already got the answer for that one. How many days will be mutual fund X will be held for? 103 days. Let's cross check. See, they've got the same answer. 103 days. C. Okay. Number of days for which mutual fund Y will be held. Let's go and check that now. Y was 31 days. Have they got the answer? 31 days. That's it. So we have got all the 4 answers, friends. Did you now understand how easily you can do MCQs? If you know the concept, MCQs are very, very easy, friends. Okay. Fine. Can I go to the next question now?
Sir, This
Yeah.
cross multiplication I was not getting, sir. Finding the value of x, Can you work out one of them, sir?
Yeah. You mean which one? This one?
Yes, sir. This step, sir. I was not getting the second step.
I'll explain to you. I'll just rub this. First, what I'll do is I'll just make it as 365 divided by x will now be equal to 9.66 divided by 2.718. That will be 3.554. Therefore, x will be equal to 365 divided by 3.554.
Sir, how you got this 3.554?
I did 9.66 divided by 2.718.
Okay, sir.
Okay.
Sir, here that percentage we should not take, sir. 9.66 as a number we should take, is it, sir?
No, if both are in percentage, when you divide, you will get a common factor, right? Even 2.718 is a percentage.
No, that 9 means
This also
point.
percentage, this also percentage. So when you divide by it, you get a whole number.
Okay, sir.
Yeah.
Thank you.
Thank you. All right. So friends, we are done with the first case study. Let us do the second one. Case scenario 2. Okay. Now here they have told is expanding its business and therefore is raising funds by issuing convertible bond of 10 crore. Okay. Is planning to expand. So they want a convertible bond. He's interested to invest in the bond, but he has the following data relating to the bond. First, they have given the face value. Coupon rate is given. Okay. Number of shares per bond is given. Market price per share is given. Straight value is given. Friends, we have done a similar problem. I would like to take that problem, show you and do it so that we can correlate both the numbers and do it so you get double exposure over here. I'll just open my notes. Give me a minute. Okay, 1 minute. We did a chapter called as security valuation, security analysis. It was security, this one. Yeah. Yes, this question, friends. Look at this question that we did in our class. Okay, here, if you look at this, you have the coupon rate, the face value, market price. Same way we have got data in this question. So what we'll do is we'll do it in the same pattern and then we will cross check. First thing that we had learned was conversion value of debenture. So here, what will be the first thing that we will have to do? Conversion value of a bond. So how did we actually work out the conversion value of debenture? We took the market price of one equity share and we found out the conversion ratio. So tell me here, what is the market price of one equity share? Convertible bond is 265, 12 rupees per share. And they are talking about a conversion rate of how much over here?
20.
Number of shares per bond is
Per bond, 20. So price of one share is 12. If I convert, I will be getting 20 shares, correct? So it will be 20 into 12. 20 rupees, 20 conversion into 12 rupees. Am I right? Do you get the answer as 240 rupees over here? Correct?
Yes, sir.
That is called as the conversion value of the bond. Same way we can find out the market conversion price. That is the other way around. Market conversion price. So what you do in market conversion price is you take the market value of the bond. What's the market price of the bond? 265. This, if I convert at the ratio of 20, I should be getting 13.25 rupees per share. But right now I'm getting only how much rupees per share? I am getting only 12 rupees per share. So ideally, will I be willing for conversion? No. Hence, I will have to pay him a premium. So what will be the conversion premium? Conversion premium will be 13.25 minus 12. Do you get the answer as 1.25? Same way, we can also find out the conversion premium. We can find out in percentage. So that will be you have 1.25 as the conversion premium and you are converting from a base of 12. So you get the answer as 10.41%. Okay. That's the next thing that you would have learned over here. We learned conversion value of debenture, market conversion price, full logic also I have given over here, friends. Conversion premium, percentage, premium over straight value. That is the next thing that we will have to find out. Premium over straight value. So now tell me how much is the premium over straight value? What is the straight value they have told? 235. But the market price is 265. So you will do 265 minus 235 from a base of 265. Correct? Sorry, divided by 235. That is because the premium over straight value means you should take 235.
Sir, can you just show this figures how you got some 265, 235?
I'll show you. You get the answer as 12.76%. See, market price is 265, but the straight value of the bond is only 235.
Okay, okay.
So you have a premium of 30 rupees over there. Okay, 30 rupees of premium on a base of 235 will give you the amount in percentage. Are you all clear with this part? Okay.
Excuse me, sir.
Yeah, tell me.
Sir, I have a doubt.
Yeah.
So in certain sums, when we are, finding out the premium or the percentage of increase or decrease.
Okay.
So, for example, in sensitivity, so we take the base as, from where the price has fallen or it has increased, right?
Correct.
But here, I mean, so in certain cases, I'm getting confused as to what to be taken.
I'll tell you. Here, when you say premium over straight value, what does that mean? Premium over straight value means from the base of 235, how much premium is your bond offering you, correct?
Okay, so
So
got
the
it.
base will become 235.
All right.
In NPV, we told from an investment of 1 lakh, if it goes up to 1,10,000, NPV becomes 0.
Right.
So whatever you say from, that from will be your base.
Okay. So this we can keep this as a general rule in order to find the
Yes.
premium or percentage, right?
Yes, we can.
Okay. Thank you, sir.
Thank you. Now, friends, let us read through the question and I'll just open the answer key also so that we can cross-check the answers parallelly. I think we got the answer for the first one. It was CACA, if I'm not wrong. Series 1. Is that the answer we got earlier, friends, for the first part? Yes, C you got, then you got A, correct, then you got C, correct, and then you got A again. Perfect. So first one is done. Now we are doing case scenario number 2. So friends, let us read the first requirement. Percentage of downside risk of the bond. Friends, percentage of downside risk is another name for premium over, premium over straight value, but it is done in a different way. So I'll just put it over here. Percentage of downside risk. That would be 265 minus 235 from 265. Downside. You get 30 divided by 265. You'll get the answer as 11.32%. Let's just cross check if that number is there over here, friends. Give me a minute. You get 11.32. So that number is only not there. So hold on. I think they have intended something else by percentage of downside risk. Is it the conversion premium? Let us cross check. Give me a minute, friends. 5, the answer is D. 12.77. Correct. So that's the same number. Okay. So they have just used a different terminology. Sorry for the confusion over here, friends. You can just write down a name that percentage of downside risk is similar to premium over straight value. Both are exactly the same. Okay. Friends, I'll give you a minute's time. Just scribble down this and understand till here. Because only then MCQs will be understandable for all of us. All right. Fine, friends. Okay. So first one, we got the answer as 12.76%. Okay. Can I go to the second part now? Okay. Now they're asking conversion premium in percentage. I think we already have found out the conversion premium in percentage. Have we got the answer as 10.41%? Shall we cross check now? Conversion premium, they've got 10.42. So the answer should be B. Let's pray to God the answer is B. Question number 6. Answer is B. We have got the same answer, friends. Okay. Now, question number 3. Conversion parity price of the stock is. Friends, conversion parity price is nothing but market conversion price. So, market conversion price is also called as what? Conversion parity price. So, this terminology we will have to remember. Conversion parity price 13.25. Just cross check. A, B, 13.25. So the answer is supposed to be C. Can I cross check over here? 7, the answer is C. So what we did is correct. Downside risk is based on the straight value answer. Market price to straight value. 265 is the market price. Ideally, downside risk means it should be from 265. So the denominator should be actually 265. But that's a bit confusing. They have done it based on 235 only. Answer, both the answers are actually correct. Here they have done it based on 235. Where actually when you talk about downside risk, it should be from 265 down. So the base should be 265. What you're saying is correct. All right, friends. Last one. If he wants a yield of 15%, the maximum price that he should be ready to pay would be. So friends, he is looking for a yield of how much percentage? 15%. So let's read the question again. They have given the coupon rate, they have given the market price of the price, and they have given you the life as 5 years. So market price is the price today, face value is 250. Friends, if he is willing to pay 15%, we have to find out. So I'll write down the next working note heading. MPS, if yield is how much percentage? 15%. Here, cash flow, discount factor, discounted cash flow. So here 1 to 5, what is going to be your cash flow for the 5 years? You'll have a coupon rate of 12%. Friends, coupon rate of 12% is ideally on the face value. So here the face value is going to be 250. 12% will turn out to be how much? 30. At the end of year 5, you get the redemption value. Redemption value, nothing is mentioned over here. So we are assuming that the redemption value will be 250. Shall we do this now? 0.497, 3.35. You get 100.5 over here. And you get 124.25. So do you get the answer as 224.75? Let's hope we have an option with 224.75, friends. 224.81 is there, B. Excellent, that is the right answer. Okay, so this is how you find out the price per share. So we are done with this question also. I'll give you a minute's time, read through it. If you have any doubts, you can let me know. All right, friends. Fine. So, friends, these were the 2 MCQ questions that have come in MTP Series 1. Okay. Now, case scenario number 3. You have one more case scenario. So, I'll write down. Case scenario number 3. So suppose you are a financial consultant and you are following 3 clients. They have approached you seeking advice on the investments. All these clients are having different background and different risk appetite. Okay. Client A wants fixed income revenues. Therefore, he's looking at the credit rating. Friends, when you say fixed income revenues means it is something like debenture or bond or any loan security. You're issuing loan, okay? As well as he checks the financial ratios such as interest coverage ratio, earning power, etc. So this is something what banks normally do. Am I right? Okay. Now let us check the second one. Client B wants fixed income over a period of time by holding the security till its maturity. So here we focus on yield to maturity. Client C wants to take more risk. He is interested to invest in stocks. He believes that the price reflects all the information about the price. So he is a person who likes to take risk. Okay. Now, so considering these 3 things, on the basis of the above, choose the most appropriate answer. The main factor to be considered in selecting the fixed income avenue for client A shall be, so tell me friends, for client A is the one who's looking for credit rating. He's more into debt investment. Will he worry about yield to maturity, risk of default, tax shield or liquidity? What will be his area of, focus?
Risk of default.
Risk
Risk
of
of default. Why? Because he's giving a loan. He wants to make sure that he gets the money back. So the answer should be B. Can we check it? 9, the answer is B. Perfect. Everybody clear with the first part? Okay, second question. What is the second question that you have? The main factor that have to be evaluated in the selection of the bond for client B. Client B wants to hold the security till maturity. So will he focus on yield to maturity, risk of default, tax shield or liquidity?
yield to maturity.
Because he wants to hold it till maturity. Now, third fellow is saying that his information reflects all information. So, is the weak form efficiency is prevailing in the market? Then which approach is best for selecting the equity share? Now, this is something what we have to derive by practice. Friends, weak form efficiency would mean that past data is not fully predictable in future. Okay, that is weak form. Strong form means market contains all the information. Now tell me, if I do technical analysis, that's a graph. Okay, graph normally does what? It takes the past data and it predicts towards the future. So tell me, if it is a weak form, will technical analysis work? Yes or no? No, because this will only help you to predict the past into the future. So if the past is not reliable, future also will not be reliable. Am I right? Fundamental analysis is the right answer. Here we will use Gordon's model, etc. Or we will take the present value of future cash flows. So this future cash flows is not done based on past. It is done based on other projections. Everybody clear? So the answer for 11 will be B. 11B. Shall we cross check? 11, the answer is B. Everybody clear now, friends? Okay, let's go back. Case scenario number 4. Friends, case scenario number 4 is a question on mergers and acquisitions. We have done a similar type of question in class. We will do it now together. First, I'll write down working note number 1. Basic data. Particulars. You have AES and DNF. AES. Then you have DNF. Okay, they have given the PAT. Profit after tax is given as 36 lakhs. Okay, the other one will be 7 lakh. 20,000. Point number B is the number of shares. So tell me, friends, what is the number of shares? You have 12 lakhs. And here you will have 3,60,000. From this, what can I find out, friends? Can I find out the EPS? And you will get the answer as 2 for the second one. Okay. They have given you the PE ratio. How much is that? 10 times and 7 times. So from this, we can go and find out the market price per share. So what will be the market price per share? It will be 30 and here you will get 14. Okay. Then let's read the requirement. They are offering a swap ratio of 1:2. So I'll write down EPS after merger. How do you find out EPS after merger? I will take whatever is my earnings after merger. So how much will be my earnings after merger? 36 and 7 lakh 20. 43 lakh 20,000. Okay. Then I will take number of shares after merger. How do you find out the number of shares after merger now? Here you have 12 lakh shares plus for 3,60,000 share, you are going to issue 0.5. 1:2 is the ratio. So 1.8 will come. So total will be 13,80,000. So from this, can you tell me what will be your EPS after merger? Do you get the answer as 3.13 rupees per share? Once I get this, I can multiply with the PE ratio of the acquiring company. That is 10 times. If I do this, I will get my NPS after merger. 31.30. Shall we now check the questions one by one and see what are they asking? Number of equity shares to be issued by AES Limited for acquisition of DNF. So everyone please interact and tell me. Okay, Yograj, sorry, I just missed out on this thing. Random selection analysis, if I'm not wrong, is similar to random walk theory, where future cannot be predicted at all. Okay, whatever is the past, no relation with the future, but that you cannot do. If you want to buy a share, you will do either technical or you will do fundamental. So friends, what is the number of shares? They got 1,80,000. Is that the same answer we got over here? Yes, 1,80,000 will be the number of shares issued. That is 3,60,000 into 0.5. Everybody clear with this part? 1 minute. Yes. So friends, we are done with question number 1. EPS of AES after acquisition will be, we have got the answer here, 3.13. Do they have 3.13 over here? Yes. Option should be C. So 12 should be B. Yes. And 13 is supposed to be C. We have got the same answer, friends. Yes. So don't get worried with MCQs. They are not going to be very dangerous. Equivalent EPS of DNF. Friends, how do you find out the equivalent EPS? It will be the post-merger EPS 3.13 into the exchange ratio of the target company. So when you do 3.13 into 0.5, you will get the answer as 1.565 rupees per share. So the answer should be 1.57 or option will be C. Let's check. 14 is also C. We got it right. If ASP Limited remains unchanged, then the expected market price per share would be, we already got the answer for that one also. MPS after merger, 31.3. See, answer is C. Are you all clear with this part now, friends?
Sir, excuse me, sir. That previous page, sir.
Yeah. I'll just give you a 1 minute cool off time. Go through this, then we go to the next question.
Not this one, sir. Last one.
Yeah.
Thank you, sir.
Thank you. Okay. So friends, we are done with question number 15 also. Now they are coming into descriptive marks. So what we covered so far was 30 marks. Now we are going into 70 marks of the question. Okay. Are you ready? They have given some beautiful questions over here. Total, how many questions are there? Let's check. 6A, B, I think 12 more questions are there for us to crack here. Am I right? Okay. Friends, we'll do MTP series 1 today. I'm not sure if we'll be able to complete series 2 also. That will become too super fast. We will do this. If we get time, we'll go to series 2. Because evening I'm again traveling today, so I'll pack up my class by around 5:30. Okay. So we'll do that. And if MTP part 2 is pending, we'll do it on a separate day. We'll spend another 2 or 3 hours and we'll finish it off. All right. Now, XYZ is an Indian firm which needs to pay Japanese yen 1 crore. So I'll write down question number 1A. Working note number 1. Basic data. Okay. There I'll write down point number A. Yen payable. Yen payable is equal to 1 crore on 30th June. 30th June. Okay. In order to hedge the risk involved in the Forex, the firm is considering two alternatives, forward and currency options. We have done exactly the same type of question in class, friends. Only the thing was not yen, it was dollars, Canadian dollar it was, if I'm not wrong. They have given you the spot rate, JY bar INR. So this is very confusing. Friends, JY bar INR, they have written and they have given you 1.7825. So which is the currency and which is the commodity?
JY
Yen is the
JY is currency.
currency. INR is
And INR is the commodity. But normally, which is the more powerful thing, yen or rupee?
rupee.
Rupee.
INR is the more powerful, sir.
More powerful, right? So considering that, I think this exchange rates are logical, correct? So they have given you the spot rate. They have given you the forward rate also. And just write down spot rate. So the spot rate is 1.7825 hyphen 1.8245. All right. And the next one is what? 3 months forward rate. 3 months forward rate. That is 1.8726. 1.8726 hyphen 1.8923. 8923. The prices for Forex currency options on purchase are as follows. Strike price or the exercise price is given over here 1.8855. Okay. Then they have given the call option. So it's a call premium 0.047. 0.047 yen and put premium. Put premium will be 0.098 yen. For excess of the balance, the firm would use the forward rate as the future spot rate. So they are going into no hedging. Okay, now they are asking which is a better option. Whether forward is a good option. Okay, Kathiravan, you want me to work out the unsimilar problems alone? Kathiravan, everybody is attending the class and many students who are already attended my regular class also. They will also need revision on these questions. So it's always better that I do all the questions. Okay, but we'll do it quickly. We'll not waste time. We'll do it fast so that we cover and revise the concepts in one shot. All right? Yes. All right. So where are we now? 1 minute. Okay, 0.098 yen. Okay. Now, once we put that, now we will go and find out first how much is the amount payable under what contract? Under forward contract. All right. So now tell me, if I'm doing it under forward contract, first I will write down the yen payable. Yen payable. Everyone tell me how much is the yen payable over here? 1 crore or 100 lakh rupees is payable. Am I right? In order to hedge the risk involved in the foreign currency transaction. Okay, now what is the forward rate? Friends, will it be the bid rate or will it be the ask rate?
Bid rate.
Wait, this is yen. It's an Indian firm. So Indian firm will do what? Buy yen. If Indian firm is buying yen, what is the bank doing? Selling
Selling.
yen. Okay. In return, the bank is buying
Buying
rupee.
rupee.
So it will be the forward bid rate. Am I right? Because rupee is the currency. What is the forward bid rate? 1.8726 yen bar rupee.
Okay.
Multiply or divide. You will divide. So tell me what will be your rupee payable over here?
Right.
53,40,169 rupees. Shall we cross check, friends, whether our answer is correct?
So this is not MCQs.
They've got 53,40,000. We got the answer as 53,40,169. Pratik, what did you say?
No, nothing. Nothing, sir, nothing.
Nothing, right? Okay. Fine, friends. So I think you're clear with the forward contract. Now we will go to the next one. Amount payable under option market. Friends, even before I start with the option market, I need to decide whether it is a call option or whether it is a put option. So I will draw the diagram again. Okay. So now here what will happen is, since it's a payable, what are we going to do? We are going to buy yen. Bank is going to
Sell.
sell yen. In return, the bank is going to buy rupee and we are going to sell rupee. So since the exchange rate is yen bar rupee, buy rupee, that is why we took it as bid rate. Same way here it is sell rupee. So what do we need? We need a right to sell. So if that is the case, what are we are supposed to do? We are supposed to buy a what option over here? Put option. Everybody clear with this part? Okay. Yes. So it's a put option. Now I will write down the next working note heading, number of contracts. Okay. So point number A will be yen payable. How much is a yen payable? Is it 100 lakh yen? 100 lakh yen is payable, correct? And now what I will do, I will have to take the exercise price. So what is the strike price that we already had wrote down earlier? 1.8855. Wait, do we have a contract size in the question? If that's not there, we really don't need to take so much of efforts.
Not there, sir.
Not there, right?
No, sir.
But they have given the sentence over here that unhedged portion you have to go for future rate. I think they have forgotten to give the contract size. Okay, they copied the question, they pasted this, but they haven't given the contract size. So actually, if this is the case, then the entire money can be hedged is what I understand, since they have not given a contract size. So what will be a rupee payable over here? 100 lakh divided by 1.8855. 53 lakh 3,632 rupees. Now, along with this Roman number 2, I have to find out the put premium also. Am I right? So first I will find out the premium that is supposed to be paid now. So what is the premium for put they have told over here, friends? 0.098 yen. It will be 100 lakh yen. Sorry, it will be in rupees. We should take it and then multiply. 53 lakh 3,632 rupees into 0.098 yen per rupee. So it will turn out to be 5,19,756 rupees. Now to this, what will I have to do? I will have to add interest. But again, I think not relevant because they have not given any interest over here. So in that
Excuse me,
case, tell me.
So the premium is in yen, right?
Yes, correct. Okay, yes, correct. Thank you for correcting me there. It is in yen. It is not in rupee, it is in yen. So if this is in yen, I will have to convert this into rupee by using the spot bid rate. Therefore, premium in rupee will be 5,19,756 yen divided by the spot bid rate. Spot bid rate is 1.7825. 1.7825. That will be 2,91,588 rupees. Okay, so I have to pay 53 lakh here and I have to pay 2 lakh of premium. So my total will turn out to be this plus 53,632. I will get the answer as 55 lakh 95,220 rupees. Can I cross check the solution, friends? Let me just cross check because they have not given full information. 55, 95, 221. Exactly. We've got the same answer, friends. But ideally, they should have had a contract size, but they don't have a contract size in this question. So I'll give you a 1 minute cool off time. I'll show you each page, read and understand each one part of this.
So just one doubt.
Yeah, tell me.
So we're converting premium in yen to rupees by taking the spot bid rate because premium is paid upfront, right?
Yeah, the premium is paid upfront. Ideally, we should add the interest.
Right.
Correct? But here they have not given any information about interest.
Correct, sir. Okay, got it, sir. Thank you.
Thank you. All right. Okay. Can I go to the next part now? I'll just go to the next page. Okay.
Excuse me, sir. Sir,
Yeah,
here
tell
we
me.
now is 5,19,756 yen, is it, sir?
Correct. Yes.
Okay, thank you.
All right. All right, friends. So we are done with this question on Forex also. Let me go to the next question now. Question number B. They have given you the expected return and they have given you the beta factor. It's a very simple problem. They are asking you whether the stocks are overvalued, undervalued, or correctly valued. Come on, friends, tell me, how do you do it? Overvalued, undervalued, or correctly valued? Come on. How do you decide that?
Theoretical.
Alpha. Do you remember alpha, friends? What is the
Return
formula for
minus required.
alpha? Come
Expected
again?
return minus required.
Required.
Exactly. So we already have the expected return that is given in the question, correct? How much is that? 20, 13, and 17. Now we need to go and find out what is our required return. How will you do that? RF 9
CAPM.
plus beta into 5 into 1.9. You'll get the answer as 18.5% for the first one. Second one will be 5 into 0.8 plus 9. That will be 13%. And the last one is going to be 5 into 1.4 plus 9. That is 16%. Okay. So now tell me what will be the alpha for the first one? Plus 1.5, 0, plus 1%. So what will be your status? Here it is undervalued, undervalued, This is neutral. So what is the decision that you will take over here? Buy. Here you can hold. Here again you will buy. Let me just cross-check the answer, friends. Give me a minute. Buy, hold, buy. Perfect. Satyaravan, you have a doubt of how the total came up? Wait, I'll show you. Let everyone just go through this. Okay, fine. Friends, now I'll just show you this. Kathiravan, see here there are two parts. One, you got amount payable in the option market. Two, it is the option premium. So this plus this is how you got the total answer. All right. Fine. All right, friends. Can I go to the next question now?
So,
Yeah, tell me. Okay. Friends, next question is a theory question. What do you mean by the term unicorn companies? Again, a new theory, friends. This is not there in the earlier syllabus. What do you mean by unicorn companies? Friends, Zomato is a unicorn company. Swiggy is a unicorn company. So the definition goes like this. Okay. It is a private company. Valuation should go above $1 billion. So now tell me, friends, is Byju's app a unicorn company? Unfortunately, no. Now the value has come down almost to zero, I think. The company has stopped, am I right? So earlier it was $22 billion. That time it was a unicorn company. It emphasized on rarity of success of such startup. They do innovation, customer focus, high on technology, etc. Such companies are called as unicorn companies. All right? Yes. Now I'll go to question number 2A. Friends, shall we take a break now? I think we have been going from 10:30 onwards. Are you
Yes,
fresh
sir.
enough to do one more question, or should we take a break and after lunch break get back to the next one?
So finish this 1:30 we can have lunch break, sir.
1:30? Everybody's okay with that? Yeah? Okay. So let's do question number 2 also, and then we will take a break. All right. DK is considering investment proposal in Sri Lanka involving an initial investment of LKR. Friends, LKR is, I think, Lankan rupee.
Yes, sir.
Correct,
Good
right?
one, sir.
Sri Lankan rupee is called as LKR. Just for my satisfaction. Yes, it is Sri Lankan rupee. Okay. So reality it is 0.28 Indian rupee. So one Sri Lankan rupee is 28 Indian. Okay. So India is more powerful over here. If this is one, that is 3.58. Right. So initial investment, I'll write down over here. Question number 2A. Working note number 1, basic data. Point number A, investment. That is 25 billion LKR. Am I right? Correct. And the spot rate is 0.37 rupee per LKR. S0 is 0.37 rupee per LKR. Okay. Next part. RF in India is 6%. 6% in India. Now, friend, India will be what? RH or RF? It will be RH. Okay. Next one. Of 1 billion each for the next 4 years. Okay. Hold on. No, we are not reached there. RF in India is 6. Sri Lanka is 5.02. RF in Sri Lanka. 5.02%. That is what we call it as RF. The project will generate a cash flow of 5 billion LKR in the first year. Cash inflow in year 1 is going to be 5 billion HKR. Sorry, 5 billion LKR. And then it will increase by LKR 1 billion each year for the next 4 years. increase by 1 billion every year for the next 4 years. For the next 4 years. The project will wind up on the completion of 5 years with no salvage value. So year 1, 5 billion, then 4 every year 6, 7, 8, 9. Like that it will go up. All right. And the required return for the project is 8%. Project is 8%. They are asking you to find out the net worth using home currency approach and foreign currency approach. One problem is whether this 8% is in India or in Sri Lanka, they have not told it, friends. That's okay. What we'll do first is we will first find out using home currency approach. Next working note, NPV using home currency approach. So here, step number 1, we have to find out the future exchange rate. Friends, we have done a similar type of problem in international financial management. There it was dollar. Here they have given Sri Lankan rupee. Concept wise, everything else is exactly the same. So let us see. Year 0, it is 0.37. Year 1, the formula would be 1 plus RH, 1 plus 6% divided by 1 plus 5.02% is equal to forward divided by 0.37. So the next year it will be 0.3768. Next year 0.3804. Next year 0.3839. So this is year 2, year 3, year 4. We need one more year. Year 5, 0.3875. 0.3875. Okay.
Sir,
All right. Yeah, tell me.
can I just tell how you did this calculation in the calculator?
Yeah, okay. What I did was I did one. Just take your calculator. Do 1.06 divided by 1.0502. Okay.
Point.
Press into 2 times. Now do plus, sorry, 0.3734.
Okay.
Now press equal to. Did you get 0.3768?
Sir, one
Again press
second,
equal
sir.
to. You should get 0.3804. Are you getting that number?
Yes, sir.
Again, you
Sir,
press
can
equal to, you will get 0.3839. So it directly
Then once again,
multiplies.
sir. Sir,
Same like discounting factor calculation.
Yeah, you are actually multiplying everything with a common. That's 1 plus 6% divided by 5.02% you are doing. Bhavya, were you the one speaking to me? I have muted you by mistake. Please unmute.
Yeah, this is the same like discounting factor computation.
Yeah, yeah. The moment you press equal to it goes on coming down. Yes.
sir, can you just tell once more, sir?
Yeah, do 1.06 divided by 1.0502. That's a common factor.
1.06
06 divided by 1.0502.
Okay.
Press into 2 times.
Okay.
Then you just do 0.37.
Plus 0.37.
No, not plus. You have done into 2 times, right? Now you do 0.37.
Okay, okay.
Equal to. You go on pressing, you'll keep on getting these answers.
Okay, okay. Thank you.
All right? Yes. Fine. So friends, once you get the future exchange rate, now, thank you, Rahul. Yeah. So once you do that, I will now write down Roman number 2. Okay. NPV using what approach now? Home currency approach. So here what I'll do is I'll draw a table here. First, I will put cash flow in LKR, exchange rate, cash flow in rupee, discount factor in rupee, and discounted cash flow. So year 0, how much is my investment in LKR? 25 billion. What is the exchange rate on that date? 0.37, correct? So I should multiply. So will I get the answer as 9.25 billion over here? Year 1, they have told 5 billion. Year 2, 6 billion. Year 3, 7 billion. Year 4, 8 billion. And year 5, you will have 9 billion. So the exchange rate every year will be 0.3734, 0.3768, 0.3804, 0.3839, and you have 0.3875. All right. So once you multiply with this, you will get the cash flows in. Here you will get 1.867, 2.2608, 2.66, 3.07, and 3.4875. Now I should take discount factor in India. So I am assuming that 8% is the discount factor in India, friends. Let's just cross check how your textbooks have taken it. Yes, they have also taken it as discount factor in India. So from this, we need to work out now. So it is 1.9259, 0.8573, 0.7938, 0.7350, 0.6805. Okay, so you will get minus 9.25, 1.7286. I just check the solution here, friends. I don't want to do so much of hard work simply. 1.865 we have got, yes, 2.2608, 2.256, 2.653, 26, 3.07, 3.465. Almost the same number, slight rounding off here and there. So numbers are correct, discount factor. So they get the NPV as 1.1216. NPV is positive. Now, friends, I need to work out the same question using what approach? Next working note, foreign currency approach. Now tell me, friends, when you do it under foreign currency approach, cash flows will be in LKR, NPV will also be in, sorry, discount factor also will be that of LKR. So I need to find out the RADR in Sri Lanka. How will I do that now? 1 plus RADR of home country divided by foreign country is equal to F divided by S. So it will be 1 plus 8% divided by 1 plus RADR of F should be equal to 0.3734 divided by 0.37. Okay. We'll get the answer as 0.1. Yes, so that is nothing but 7.01%. Okay, let's just confirm. Yes, 7%. We also got 7.01%. So once you get this, then we need to just work out the final NPV. NPV using what approach now? Foreign currency approach. Okay, here I'll write down here. Cash flow in LKR. Discount factor at 7%, discounted cash flow. So year 0, you're investing 25, then you get 1, 5, you get 6, you get 7, you get 8, and finally you get 9. 0.7129. Okay, so once you do this, you will get the NPV. So you get the answer. I'm not doing the remaining part, friends. You will get 3.1477. So friends, both the NPVs are positive. I have told you NPV under home currency and foreign currency will actually give you the same answer. So I'll come over here and I'll write down NPV under home currency. I think you got the answer as 1.1216
This is billion, no, sir?
billion. Everything is in billion. Then we are doing under foreign currency. Under foreign currency, you got 3.1477 into the spot rate. I think the spot rate is 0.37, correct? You will get the same number ideally. What is the spot rate? 0.37. 1.646 is what you get over here. Other one, we got 1.1216, is it? That's the rounding of difference, friends. Ideally, you should get exactly the same answer, okay? These two are the same. You are only having a rounding difference. Everybody clear with this part now, friends? Yes, because I took 7%. Actually, it's 7.02%. The slight deviation will come. So that's it, friends. So we have solved this question using both home currency approach and foreign currency approach. I hope you're all clear with this part now. Yes. Friends, there's a small question. We have 10 more minutes for 1:30. We'll do the next one also, and then I'll give you a break. That's a small one, and it's an easy question. It is a question on dividend, Gordon's model. So let's write down working note number 1, basic data. Question number 2B. Working note number 1, basic data. Everyone, please mute yourself. Done. So here you have D0 is 5. KE, cost of equity, is given in the question as 10.5%. They have also given you the growth 4%. So friends, from this, can I find out the price using Gordon's model? Tell me what's the formula for Gordon's model? D1 divided by KE minus G. Do you get the answer as 80 rupees per share? All right. Let's check. 80. We got the same answer. All right. Then they're asking you in second part, evaluate whether the stock is overvalued. If the stock price is 70, ROE is 18%. Let me go to the next page now. Analysis of situation number 2. There I'm writing point number A, stock price. So actual stock price is equal to how much? 70 rupees. Point number B, ROE, return on equity, is given as how much percentage? 18%. E0 or the EPS is given as how much? 4.50 rupees per share. All right. Friends, now here ROE is a slightly tricky area. Ideally, what is the formula for ROE?
Add divided by equity plus reserve.
Okay. So have they given the book value anywhere? They haven't given the book value anywhere, correct? So now since nothing is given, they actually treat ROE differently. We'll just go and check what they have done. What is the stock price? 70. ROE, we took 18. EPS, we took 4.5. Okay. So they have found out PE multiple as 1 divided by KE. So basically, even though ROE is given, they have wrongly assumed the ROE as KE. But in reality, both are different. So ROE and KE is assumed to be the same. So once this assumption is done, then they find out that 1 divided by KE is equal to PE ratio. So in other words, 1 divided by 18% if you do, you get the PE ratio as how many times? 5.55 times. Okay. So once you get this answer, I will now find out the MPS using PE approach. So here I'll write down EPS. What is the EPS that is given in the question, friends? Is it given as 4.5? Point number B, PE ratio. What is the PE ratio, friends? 11.11 times. So MPS will turn out to be how much over here? It will be 50 rupees per share. Last one, they want you to find out the answer using earnings capitalization method. What is the formula for earnings capitalization method?
PE ratio, no, sir, 5.55.
PE is 5.56.
Oh, I took a wrong PE ratio, is it?
Yes, sir.
So sorry. What is 11.11? I don't know from where that number came in my mind. So I think you'll get the number as 25 rupees per share in that case, correct?
Yes, sir.
Correct? All right. Now here it is E1 divided by KE minus G. But I think E0 is already given. How much is the E0 given over here? 4.5 divided by directly they take KE. And the KE is already given in the question. How much is the KE given in the question? 10.5%, correct? ₹42.85 per share. Shall we cross check? Here they got 25. Okay.
So you
No, they
did
have taken,
minus
The growth, you have to add
they have
growth
taken the
to
growth
this.
also. Sometimes they ignore growth. That's why I did it this way. What is the growth that they have given in the question?
4%.
4%.
Have they given directly in the requirement itself? Sometimes they ignore it. Okay, it's directly, where have they given 4% is given here, right? Many questions they directly ignore it, friends, and they do it. Here they have used it. Okay. So once you do it like this, what is the answer you get over here? Do you get the answer as 72 rupees per share?
Yes, sir.
Let's just cross check. 72. All right. Now, what is the actual market price that is told in the question?
70.
70. Okay. So it is undervalued or overvalued?
Undervalued.
Undervalued.
Is 70. Okay. So theoretical is how much? 72. Hence, actual is undervalued. And if it is undervalued, what are you supposed to do? We are supposed to buy. Are you all clear with this part now?
Yes, sir.
Fantastic. So we are done with this question also. We are done with question number 2. Question number 3 is a beautifulest question. Portfolio management. We have done the same type of problem in class, but it's a very, very good question, friends. We'll take a break now. Okay. After 1 hour, we'll get back at 2:30, and 2:30 we will start doing the remaining problems. All right. So I think in one shot, we will sit and complete off the remaining questions of series 1 from 2:30 onwards. And I think it will take another 2 hours or 2.5 hours. How much ever time it takes, we'll complete it completely. And then, friends, we'll pack up our session. Series 2, we'll do it at some other time. I will announce it very, very soon. All right, friends? Okay.
In question number 2, C part is there, sir.
Question number 2. Is there one more part? Hold on.
Theory.
Sustainable growth rate. What is the formula for growth rate, Ramya? Retention ratio into rate of return.
ROE.
That concept is what they have brought in as theory. Okay.
Okay.
Sir,
All right. Yeah, tell me.
in the second part, using PE approach, you are getting the price as 25, right? So it's
Correct.
overvalued, right?
Overvalued. So you will sell. Correct.
Okay, sir.
Thank you, friends. Thank you so much. See you after 1 hour. See you at
Thank
2:30.
you.
Yes, Pratik?
No, sir, not me.
Okay. Okay.
Thank you, sir.
Thank you.
I'll share a new link. Or if the same link is not available, I'll share a new link.